So we're going to kind of do two things today. We're going to talk about real estate, both where it's been at a little bit and where it's going. And that's going to be, I think, the educational piece of this. And we're also going to talk a little about why we put OK together and what our value proposition is. Can you hear me, Diana? Okay, well, since you're in the bathhouse, then everyone can hear me. And can you all see the screen okay? Yes. No, this isn't working. I need to go back into. Am I in it? This isn't working. This was working a second ago. Well, I guess you could do them. Don't know why to stop working. So Paul is in the back, and I'm Barry. I'm the CEO. Paul is the chairman of OK. This slide. So I was, and I'll kind of get into this, but prior to this, I was the CEO of the acquisition fund, buying lots of apartment buildings in the deep south. The fund's still up and running. It's a little over 300 million. Before that, I was an officer of PennyMac, and I was a founder and officer of Countrywide Bank. Started off at Deloitte, got an MBA right here, and then BS in Berkeley, like you. Pause. Right. Paul is pioneering a PIPE strategy, which is private investment into public companies. A lot of experience with emerging growth companies, both public and private. A lot of experience in operations and finance. He's overseen over 700 capital market activities, lead investor and advisor to several growth funds. When I hit the, you can all see this okay, right? Yeah. So why did we start OK? Why did I leave the acquisition fund? Why did Paul do this? Why 100% debt fund today? And kind of what's the rationale? What's the thinking? So if you could hit that. So this is kind of the real estate cycle, guys. It goes about every 18 years. And we kind of all live through this, right? There's a boom market, overbuilding, saturated market. Vacancy increases, rent reductions, there's a recession. The last one of these was 2008. There's a great article, which I'm happy to send to you, written by a PhD in 2006, where he said, I don't care about interest rates. I don't care about anything else. There will be a crash in 2008, 2 years before, because of the amount of oversupply versus demand. And it really does come down to oversupply and demand. And then there's more demand and people build and a lot of construction. It's a boom. And like I said, it's about every 18 years for the last 150 years. The only exception to that was World War II. And with COVID, maybe it might get stretched out a little bit because of the 0% interest rates. Can you hit this? For those of us that lived through this, you know, confidence, enthusiasm, exhilaration, jubilation, worry, nervousness, alarm, dread, gloom, depression, reassurance, relief, and confidence. The average person in this country in 2008 lost 40% of their net worth. So I know there's some younger faces here, but also some that lived through this. But I don't know if you all remember that 2008 was pretty darn bad in 2009. So let's get into it. Let's talk about where we are, where we've been, where we're going, retail, office, and then kind of, and I put these separately because those two have unique factors, but residential, industrial, medical, storage. What are the factors, interest rates, liquidity, what about the next few years? And by the way, how many of you, oh good, you found it, congratulations.
Thank you.
There's coffee and pastries too.
Oh, great, thank you.
I'm sorry I had to get going, but yeah.
No, yeah, I was late.
No, we're just getting going. So how many of you are happy with your CD rates, your money market rates, bond rates? Yeah, it's pretty bad out there, huh? It's interesting how low interest rates have been now since kind of the start of this pandemic. But let's kind of get into look at some specifics. So in terms of residential, and I get back again to this supply and demand, residential is actually doing extremely well. There's been a huge surge in real estate pricing. As a matter of fact, homes prices spiked by double digits in 78% of metro areas last quarter. That's the most recent data that we have. And S&P CoreLogic reports 19.5% annual home price gain in September, which is their most recent month. So home prices are going crazy, and it is again supply and demand. What's been happening is there has been 4 million less units built than demand each year since 2008. So supply and demand are really out of whack. There's simply just not enough housing in this country.
Multi in a year.
I'm sorry, a year. That's
So
national.
you're talking about what?
Oh, that's national.
That's national.
Right,
4
so
million.
really you're talking
In this
40
area,
million, we're talking 60 million residents.
Yeah, both single family and multifamily, yeah. So there's a huge delta between the amount of housing needed and the amount of supply. It's really a big problem. And by the way, low income is even much worse than that. And there's a lot of reasons, if we want to get into it, in California why there's problems too. We have a lot of ordinances here, like our governor passed, that says you have to, on all new homes, put in solar panels and things like that, that just make affordable housing really, really tough. So multifamily, the pandemic pricing is officially over. It was hurt for a little bit, and they've begun to rise again and again. This is that delta of people need a place to live. And it's interesting because we all thought that when the pandemic hit, people did stop paying rent, but they got a lot of help. And prices are now been going back up. This is 2021, and you can see August, September, October. So multifamily is going way up again. And it did take a little dip. The cap rates are going, you guys know what cap rates are? So cap rates are how much cash flow you get for the price that you buy apartment building for. Cap rates are going really way down again. And actually, that's what got me involved in this. Oh, good, welcome. Sorry, I know it's hard to find.
Yeah, sorry about that.
No, have a seat. So, yeah, for a multifamily now.
King of multifamily.
You're the king of multifamily, well, welcome. So you can relate. So when I was buying multifamily after the crash in Alabama and Georgia and places like that, I was getting 10 to 12 cap rates and like that. And those became around a 4. And that's when I said, this is crazy. We need to start a fund that's a lot safer for investors. If you guys think about it, in all acquisition funds, the way it works is, and this is all of them, all real estate funds, whether they're public or private, when they buy an apartment building, they take the bank loan, say 70, 75% of the purchase price, and an investor money, but debt is always senior, always to equity. So that bank loan is always senior. The investor money is always subordinate to junior. If that property is bought for 15 million with a 10 million bank loan and 5 million investor money, and that goes down in value, say to 10 million, the bank comes out whole and investors lose all their money. And when you're talking cap rates in the deep South at like 3 or 4 for C properties, you know something's wrong. And you're probably, are you in California? So you're probably buying 3 cap, 4 caps right now. And you're probably getting your wish. Yeah,
I wish I had money.
you wish. Well, that's about where things are now in California. You're about a 3 cap, 3.5 cap at most on a C, B property. A properties are probably 2.5 or 3. So that's what I wanted to do. I wanted to start a fund where if there's a $15 million property bought and our fund finances, say 10 million of it, and that property, and then the borrower puts in 5 million, and that property goes down in value from 15 to 10. our investors come out 100% whole and the borrower loses money. So this fund and all debt funds that do this have shifted the risk from the investors to the borrower. That was the whole reason that we did this. And Paul was saying the same thing. He had been on Wall Street and was looking for something a lot safer for his money. And my money's in it too, and also investor money, a place where he could not have the ups and downs and be a lot more relaxed and putting words into your mouth.
Yeah, less volatility.
Less volatility. So the cap rates are really low. If you look at too what's going on here, and again, this is supply and demand. Look at this vacancy rate. I've told some, Orange County 2%, San Diego 2.3. Historical is over 5.5 to 6 on a good market. We're at rent growth of 21, 22, 30% in some of these areas, and net absorption in 12 months is just huge. It's what's happened too, and I think a lot of you have heard of this, but liquidity is the highest it's ever been by far. When the pandemic started, the government started printing a ton of money to help. They also started buying bonds again, which you guys might remember from the 2008 era. It was called quantitative easing back then. They didn't use the term quantitative easing again, but it's the exact same thing. It was the government buying bonds to infuse a lot of cash. So we had historical high printing of cash, and then all these companies could borrow with 0%. So they did. So everybody had money. So they were chasing assets, right? So you have stocks at the highest price to earnings ratio in history by far, because like I started saying earlier, bonds are at 0, CDs are at 0, money market accounts are at 0. So people have to put their money somewhere. So even though we had the pandemic, it was going into things like real estate. It was going into things like the stock market. But I worry now because these PE ratios are really crazy. They are really, really high. And you know, if you look at how much income the company makes in order to justify that price to earnings ratio, you know, some of these companies are 300, 400, 500, like a Tesla or an Amazon. It doesn't make economic sense. People, I guess, are just, you know, the greater fool theory. I can make money and then sell it to the next guy who, and maybe that works to some degree. Let's keep going. Office has been hurt a little bit, and that is by the pandemic. So it's really interesting if you look at this. So rental rates when the pandemic started really dropped, but now as people have started to go back, they're actually coming back up again. And a lot of companies are moving to this hybrid model where they're part-time in the office, part-time. Some companies, a lot of Wall Street companies, are now full-time back in the office. Other companies that are trying to be more progressive are hybrid models. The vacancy rates, as people run out of leases, have gone up a little bit because of this hybrid and companies just taking less space. But with this hybrid model, they're moving to something called hoteling, where they're just taking less space as their leases come up. And when people come in, they're getting a place to put their laptop and their cell phone, and they're hoteling. They're not getting permanent offices anymore. By the way, I'm happy if you guys want to interrupt me to talk about any of these. We can kind of keep going here. Industrial has actually picked up. And the reason is, and this is also the reason that retail has been hurt a little bit, it's Amazon, guys. It's Amazon, it's Amazon, it's Amazon. So if you all remember way back 4 or 5 years ago, you would get a package from Amazon the next day. Now it's 2 hours. So what Amazon is doing is they're putting industrial warehouses in every single suburb. It's called a hub and spoke strategy. And you're now getting packages in 2 hours because overnight wasn't good enough. And industrial is really picking up, and it's been picking up. And this is kind of the Amazon effect. This is kind of 2008. It's been going up and up. And then it took a little dip at the start of the pandemic. And it's now way back up again. Kind of the same thing The vacancy rates have gone up a little bit as some leases have run out, but it's the same kind of story of Amazon kind of taking over the world. And then, can you go to the next one? And then retail has been hurt a bit, but even retail has been bouncing back from the start of COVID. If you take a look at it, kind of, this one was a little bit shorter time frame, but since 2015, it has been going down and down, and that's the Amazon effect. But kind of at the beginning of COVID, it kind of hit its bottom, and it's kind of going back up now a little bit, kind of the same thing with vacancy rate. So what you see here is kind of a little bit bifurcated, where retail, because of Amazon, and office, because of COVID, have both taken little hits, but are kind of still doing okay, just not great. And storage, senior facilities, multifamily, residential are going crazy.
Industrial is going crazy. Also.
Industrial meaning the warehouses and
If
things
you
like
want to
that.
buy an industrial building,
Yeah,
I mean, it's gone up. It's ridiculous. You go to the South Bay, they're getting almost $300 a foot.
exactly. Industrial, and that is also the Amazon effect. A lot of the retail being hurt is helping industrial, as more and more people are shopping online and more things are getting delivered. It's industrial is probably number 2 in terms of rise after multifamily and residential. Kind of looking at retail space, there is some, I wrote this down for California, retail space percent without new development plans. You can see that it's the lowest it's been the last 2 years. As we look at people wanting to build more retail, it's just really low right now because they're all moving their assets. You know, it's interesting, there was a big retail space right here in Westwood that was just converted into condos. There was another one that I know that was converted into condos, which is basically the same price as tearing it down and starting over. But a lot of retail is getting converted into either condos or townhomes, that sort of thing. So again, you can keep going. Kind of industrial space demand versus supply. Here you can see it's growing to the point you made. And all this data is about as recent as it gets. You want to keep going here. So kind of this tight labor market, strong consumer demand, rising prices. CPI in October was 4.6 higher than a year ago. And what's really going on now is the next couple of years, inflation is going to be big. It's going to be at least 5 or 6% in 2022, according to all the economists. So if you think about it, if you're in, say, a CD or a bond or a money market and you're making 1% or 2%, you're actually poorer at the end of the year. What's happened here is with all of that printing of money, with all of the buying back of the government bonds, inflation is just going to go nuts. And that's the consensus of almost every economist. And that's kind of what I'm trying to cover here. The Fed has announced a minimum of 2 interest rate hikes next year. They said there may be more. So what we're really looking at over the next 3, 4, 5 years is a lot of inflation. Those of you that refinanced in the last year and locked in a good rate, good. Because a year from now, rates will be at least a point higher. 2 years from now, they'll be 2 points higher. I don't think we'll get back to the, remember the Carter administration, when you could get a nice mortgage rate at 18%?
Trying to sell industrial buildings.
Yeah, exactly. So I don't think we're going to be back to the 18%, but there's going to be a very strong upward rates for the next 4, 5, 6, 7 years for a lot of reasons. But the main reasons are this liquidity, this printing of cash, this infusion of capital everywhere, the interest rate hikes. You can't print this much money month after month after month and not expect there to be inflation. So what is it? Let's go back one more. Can you go back? So what does it all kind of boil down to? It's really kind of the big factors of what I'm trying to emphasize here is supply versus demand where supply is still way under demand in residential, multifamily, and industrial. It's not as much in retail and office because of Amazon and because of COVID. And then kind of the rest of the sectors are just kind of growing, but liquidity is the biggest issue here. There has been an enormous amount of money chasing everything, whether it's stocks, whether it's real estate. Everybody's looking for yield and everybody's competing with each other. I get big funds telling me all the time, I don't know what to do with all my money, but I took it because it was 0% interest rate. So how do you maximize safety and obtain a great return for the next 4 or 5 years, knowing that there's going to be all of this inflation and that prices are kind of really high on stocks with these kind of crazy PE ratios? All right, and this is kind of, again, the traditional CDs, the low rates, the stocks, the highest PEs in history, bonds, low rates, and as interest rates start to rise, I know all of you that are here from the MBA school know this, but as interest rates start to rise, bond prices go down. So if any of you don't know that, interest rates and bond prices. So if you own bonds now, when the Fed takes us 2 rate increases next year, you'll lose value. So they're inversely correlated with interest rates. Okay, so you kind of have traditional debt funds, and in traditional debt funds, investors, money is in like government and corporate bonds, debentures, kind of other money market instruments. Problem with that is they're not paying anything. They're all at around 1.5%. And when you're looking at 5-6% interest inflation this year, and maybe even more next year, it just doesn't really work. Then you kind of have these traditional real estate funds like the kind I was running. And if real estate continues to skyrocket, it could be okay, but I worry about that 18-year cycle. And I really worry about the fact that the cap rates, remember how much cash flow you get for the money you spend, are so crazy today that real estate is due for a correction, even residential, multifamily, even industrial, maybe not this year, maybe not next year, but soon. And all the rest, retail, office, have already started that correction. You have other kind of lending debt funds. The issue I have with those, and I'm just kind of laying it all out for you guys, is most of them put on leverage. So they do kind of similar to what we do. I know you do mortgages at Morgan. They do kind of similar to what we do, but they'll take what's called an advance rate of, let's say, 65% of their mortgages, and they'll bring in money that's cheaper than paying investors. It's less expensive, it's institutional. Problem is, that is ahead of the investors. So again, if there's a decline in the market, if these real estate prices go down, that leverage on that fund will go to the institutional guys every penny before the investors get a cent. Most debt funds have leverage. We're one of the few debt funds that have no leverage. So 100% of our investor money is in these loans, which are senior to all the borrower money, but not junior to anything in terms of outside leverage or that type of thing. And that kind of brings us to LK, which I'm now going to kind of chat a little bit about. I'm going a little quickly, so if you guys have questions. But so what is kind of private lending? This kind of provides borrowers access to loans for various reasons. But as I mentioned, there's the down payment, there's the purchase, there's the loan. This is always senior to that. Can you do the next slide? So why? Why do people come to us? We do kind of higher rates than a bank, than Fannie and Freddie, which is why we're able to pay 9.5% since inception of the fund. So why? There's a couple big reasons. I don't know how many of you have heard of something called defeasance?
Oh, what?
Defeasance. You have to. Yeah. So Fannie and Freddie, the big banks, they don't want to do a loan to have you flip a property. They just don't. It's too much work. That's not set up that way. they will charge hundreds of thousands of dollars in defeasance if you refi out or you sell that property in 6 months or a year or 2 years. It's another way of saying a prepayment penalty, but they're really, really onerous. And unfortunately, I know this firsthand. You do not want to sell a property during the defeasance period, and some of them are 10 years. That's bad. So if you know that you're going to be flipping a property, which by the way is almost every single house flipper, but there's also a lot of commercial flippers, you don't want to go to Fannie and Freddie. You don't want to go to a bank. You want to go to somebody that does a 1-year, 18-month loan when you know that you're going to be flipping a property. Kind of the other side of it is Fannie and Freddie, where they'll come to us and they'll say, you know, this guy's at 85% occupancy, but the market's at 90% occupancy, or $100 a month under market rent. Give them a 1-year loan, let them get up to market occupancy or up to market rent, and then we will give him a long-term loan. So they'll come to us. We're a little bit more oriented towards market value appraisals. The Fannie and Freddie look at things like, are you above or below market occupancy? Are you above and below market rent? They look at a lot of things like cash flow and debt service coverage ratio and things like that, where we're a little bit more is there a lot of value? If the value of the property today is 15 million and we're loaning 6 million and we had to sell it tomorrow, are we very confident that we can get that 6 million? So we'll still look at things, but not to the extent the cash flow and debt service coverage ratio of maybe a Fannie or a Freddie. And as you were saying too, you were saying that we're eating some of your lunch. Banks are really conservative right now, really conservative. And, you know, I've never seen loans in B of A as conservative today. I've never seen them as conservative. They're turning down loans that they would have done 3 years ago.
Right.
I guess they're projecting a downturn. That's all I can think of. The economists at Wells and B of A and Citi must be projecting a downturn because of that conservatism. But so that's kind of the two big reasons, is kind of the fix and flip, whether it's commercial or residential, or kind of get me up for something that then gets into the things. And then there's kind of two types of people that play in this game. There's a lot of private lenders that will get a loan and then they'll go to their Rolodex. For those of you under 40, they'll go to their contact list in their computer. And then they'll try and find somebody to finance it. I don't like that. I think it's risky. You telling a borrower that you're going to fund it and you may or may not get an investor. And that's by far the majority of people in the direct lending space. So what we have is a fund, and we have the money prior to ever doing an offer. It's called an LOI, letter of intent, on a loan. We know we can fund, and that builds up a reputation too. But the other nice thing that I like about a fund is that all the investments, all the investors are pooled. So if there ever is an issue with one loan, you're in all the other loans. The way it works is 100% of the loans are owned by the fund. And we have two funds. We have a Reg D fund for accredited investors and a Reg A fund for non-accredited investors, but they're treated equally. Accredited, you guys know accredited, it means you have $1 million excluding your primary home, or income of 200K a year for 2 years by yourself or 300 with a spouse. But they're treated equally. So they're not different in ours. But that's kind of important because 100% of the loans are owned by the investors. 100% of the loans have the fund name on them. Investors own 100%. When we started these, you know, the lawyers said, do you want as management to own any of these funds? And we said, no, we're going to come in with our own money, just like anyone else. So we wrote checks, big checks, but they're in the fund just like you guys. So what happens is the interest comes in every month from the loans to the fund and gets dispersed to the investors. There's a little AUM fee, asset under management fee, but basically it's 99% of the interest because there's a 1% AUM. 99% of the interest comes in and then goes out. Where management kind of oversees it and steps in and makes kind of, we pay our overhead and our rent, is we get a point or two on the loan. So that doesn't go to the investors. That's kind of what we get for doing our diligence and that kind of thing. But the fund is 100% owned by investors. All the money comes in from the loans and then goes out every single month to all the investors. And we like the fact that then you're spread out across all those loans. You know, when I graduated here at Anderson, somebody once said, define MBA in one word. And we have a few here. Hi, welcome. Sorry, I know you probably got lost. I'm sorry. I'm happy to chat with you afterwards, but sorry again. And in any case, the word I came up with, and maybe you guys have a different word, but the word I came up with was diversification. And that was hammered into me here, was diversification. I like the idea that you're spread across all the loans and not tied to one. Let's keep going here. Stuck. Yeah. So how do we protect the investments? It's thorough underwriting. It's sourcing the loans. It's using technology, which immediately gives us a valuation, but then we hire third-party appraisals. You probably know this, but we get MAI appraisals, which are the best you can get. We do Made is instructed. Oh, we have a cynic in the room. I don't think you get better than MAI. And I say that partly because I'm biased, because when I was at Deloitte, I wasn't MAI. Physical inspection, appraisals, environmental reports. Though with that said, there's some areas, if it's a dry cleaners or a gas station, we're probably just not going to loan on it. Background checks, credit reports. So it's a pretty thorough, even though I told you we're more oriented to market value than the banks, we're still looking at these things. We still want to make sure that the borrowers have a good track record, know what they're doing, that sort of thing. So we have very strong cash flow considering the safety, which is how we structured this to start it. We've done 9.5% since inception. And again, that's because we're doing one-year bridge loans and people expect to pay more for those. And then they refi out and they go get a Fannie or Freddie or a bank if they're keeping it, or if they're flipping it, then they flip it. And the flippers want us. They don't want the long-term with the defeasance. We've never missed a monthly payment. We're really conservative. We're at about a 53% LTV across the fund right now, loan to value. And this is again, those third-party appraisals. Safety of principal is a primary objective. What else I like about this too is there's no interest rate risk. When you have a one-year loan, we can adjust them every year with the new loans. If all the rates are higher in a year, we'll be higher in a year. When you stick yourself or your company with a 30-year loan or a 15-year loan that's fixed, if rates go up, it's not a good place to be. I mean, there were things we could do with Countrywide Bank where we would buy offsetting instruments. Those of you that come from banking probably understand this, to kind of shield some of the risk, but not all of it, from a rising interest rate. But it's pretty risky as a company if you're on long-term mortgages and interest rates are rising year after year. You don't want to be in that place, which is why they give such a discount for variable rate mortgages. But we really like that there's no interest rate risk. There's no load. For those of you that don't know what that means, there's no points that come in or points to exit. You're not going to give us 100,000 and then the next day see in your statement that you have 95,000 because there was a 5,000 load. For that reason, too, we will not let broker dealers sell this because they all want a big commission load. And we're not structured that way. We're giving all the interest basically to the investors. So they want their 7 to 10% commission. And we just say no. We have some RIAs who charge a 1% fee to their clients on assets under management. And those are okay, but we're not doing the broker dealers. And we can take IRA money, 401k money up to 25% of the fund. We are limited from ERISA to 25%. So you want to, a couple more things, and I think this is really interesting, especially because we're in this academic setting. But Yale and Harvard have outperformed the market every year. And what I find really interesting is how much of their, and this is billions of dollars, how much of their funds are in public versus private. And by public, I'm talking stocks, bonds, all that, CDs. So Yale has 75% in alternative investments and Harvard has 58%. That's pretty big. I mean, you think about like what most people think is, you know, buy stocks, buy bonds, buy stocks, buy bonds. And then you look at like what these big institutions are doing. They're not buying stocks and bonds. They're in real estate. They're in debt funds. They're looking for yield and capital appreciation, and they're not waiting on the stock market ups and downs. So I thought I'd give you guys some examples of some loans we've done to kind of make it a little bit more tangible. This is one in San Jose. This is the second largest owner of properties in San Jose after Google. So this is a bridge loan until he secures a large construction loan to build 3 towers. The property value purchase price of 22.5 million, borrower's net worth of over 100 million. You know, from us, he just wanted 3.5 million to get him through some things, put down 8.25 million, 12-month loan, personal guarantee. This one's at about 10.9%. You want to hit the next. Here, I mean, each one has an interesting story. This is the widow of BCBG Cosmetics. You guys know them, they're kind of multinational. He passed away. The widow was looking for some cash out and some properties. This one was just to have some access to some working capital. But again, it's 39 million property value on a third-party appraisal, a financial statement of over 200 million. For us, you know, pretty conservative, 3 million, 12 months, 10.9%. Again, if we had to sell the property, we're still covered. Let's do the next. We also do residential. Again, these are not owner occupied. These are residential where they're adding a lot of value. Maybe they're buying one that's in disrepair and it needs a big rehab. Here's one that was valued at 20.6 million. Gorgeous home in Newport, 3 million, 12 months, personal guarantee. The guy had originally bought it for cash. It's funny, he put that 3 million into a friend's business. But that's okay because the equity's there, right? If he wants to take some money out from his while he's flipping it or doing whatever he's doing with it and put it into a friend's business, that works for us. Let's keep going. This is the smallest one we've ever done, but I want to give an example of a small one. It's a little 3-bedroom, 3-bath in Venice, 315,000, 10.9. It was for her to fix it up and make it beautiful so she could sell it. Keep going. Here's one in Irvine. This is interesting. These guys sold jet skis, watercraft, racing boats. Does a loan from us to get it ready and prepped because she's going to sell it. Actually, another widow. We give the loan, 12 months, a little over $1 million, and 3 weeks later she sold it and paid us off. 3 weeks later, so we get, you know, a couple of points, get a great interest rate, and then we can turn that money over again. She actually sold it to Montessori. That's now this. What you're looking at is now a children's school. Each one has an interesting story. Here's another high-end residential. Again, very experienced flippers. They've done a lot of homes. Some of them have very high net worth that are part of this. And property value 26 million, 1.8 to 5 million from us. They're probably just trying to finish up a few things to get a certificate of occupancy, to get it listed, and then to sell it. Could we turn around and sell it tomorrow for 5 million, 10 million easily? So we're just real conservative. Let's keep going. Another one in Beverly Hills, pretty nice homes, huh? Third party appraisal, 35 million, new construction, couple $1 million, 11.5% rate, came to us from a broker. Let me keep going. This is that same borrower in San Jose, the second largest owner of properties after Google. Bought another one, pretty ugly. He's turning it into something very beautiful. We are basically the bridge. So he gets the money from us, and then he's going to turn around and get a large construction loan. We're not doing construction loans right now. They're very labor intensive. You got to constantly monitor where the construction is at. So we're just not doing that. What we're telling them is when you get that big construction loan and you're ready to take that on, just pay us off. Here's another one in Beverly Hills, purchase price 9 million, loan amount about 1.4, little quick 6 month, for things like flipping, business purpose. So the fund is about 750 million. It's about 9.5% since inception. There is a 12-month lockup, though. If there's extenuating circumstances, we're happy to address those for sure. There's no fund fees. There's an asset under management fee of 1%. That's why when you saw a lot of those loans were like 10.5, but it's making 9.5. That's kind of where that goes. You do, which is unique to us, you do vest the day you invest. And that's because management has some money in outside the fund as a promissory note. So when a new investor comes in, that promissory note can go down. That's funding loans, and that investor can be vested immediately. And that's been really well received, because the way, if any of you get our PPM, the way the PPM is written is you have to wait until the next loan is funded, and then you could be sitting for 3 weeks, 2 weeks, making a bank account 0.5%. So we've eliminated that, which is nice. Employees own a lot of the fund too. You do get a check every month unless you want to reinvest, which most of the 401k and IRA people have done. Warren Buffett said his favorite term in the world was compound interest. So if you get a check every month, you'll get simple interest. If you reinvest it, then the balance grows and you'll get compound interest. I'm gonna keep going. So the way it's structured is there's an S Corp, which is LK Advisors. And then there's kind of these two funds I mentioned, the Reg D for accredited and Reg A for unaccredited. And this is just us trying to be egalitarian. Most people have that Reg D fund, and that's it. We wanted to not just be for rich people. So we started the Reg A to kind of open it up to the other 97% of the country, give them a chance to have safety and make a great return. They each have their own legal counsel. The Reg D is Doss Law. The Reg A is Gerasi. They each have separate accounting firms. Matthews, a company CPA, Dunner & Foote. And then for sub-servicing, we use both FCI and SLS. This is kind of the org chart. And some of them are here, though I think Patrick and Natalie are still trying to help people get in. And some of them aren't here, but this is kind of the org chart. Let's keep going. And investor kind of says we've had 100% retention, which is awfully nice. We've had additional investment from 74% of our investors, so that's really nice too. So that's kind of me giving you a background of where real estate is, kind of really emphasizing that liquidity is crazy right now, and has chased the market and has chased real estate. And, it's kind of where supply and demand is in all the real estate. And then why we set up our fund the way we did, with kind of safety first, but still able to do a good return. And that's kind of it's kind of as quick as I can. I think I'm even going to get you out in time without Q&A. So thank you.
And if there's any questions, I'd love to address those as well. Barry's partner, Diana is my wife, we're all partners. We got into this for very fundamental reasons. You know, we as a couple have financed companies on Wall Street for many years. 3 years ago, I was 58. I went through a couple of big cycles. And I told my wife, well, I'm going to turn 60, and I don't want to be subject to the volatility of Wall Street. And that was, you know, like I've been through that too often in my career. And why don't we start liquidating our interests and find a really safe way of investing? One of our close friends is the largest hard money lender in the state of California, and went to him, he's a lawyer like my wife, and said, what do you think? He said, well, definitely, it's a great idea. I'll help you all the way. And so we really pivoted hard, and we said, okay, we'll start liquidating, whether we're at the top, the bottom, the middle. We just felt that that's a good way to mitigate risk and sleep at night. I'm 61 now, so we accomplished a lot of those tasks. We didn't expect COVID, of course. And we really look at the quality of the borrower, the sponsor. We look at the quality of the real estate we're lending against. And we're putting our money, you know, we eat our own cooking. I mean, this for us is something we can do for the next 20, 30 years, God willing, and sleep at night and know that we have very, very secure loan to values. We've all are old enough to have been through enough cycles. You know, Wall Street, I would say, is a lot rougher than lending money on real estate conservatively. But that's what we decided to do. You know, build a different career in a very secure area, finance in real estate. In California, that's the best real estate around. I think we can't go to other states opportunistically, but I think there's enough to be done here. And quite frankly, 3 years ago, I thought we'd have a recession based on cycles. That didn't happen. We did have COVID, but the only thing that saved us all in COVID was quantitative easing. I mean, our government pumped in. I think there's an argument on what they really pumped in, but you know, some people say it was 4.5 trillion. Other people say it was 7 trillion. Some people say it was 8 trillion. My guess is maybe we'll learn one day what the real number is, but the point is that's never happened in the history of this country. It's never happened in the world. Quite frankly, there's more money in the world than ever before. But what that leads me to believe, and I'm more convinced than ever, is that a lot of that money found its way to Wall Street, and now we're seeing the volatility. I mean, if last week, the week before, you know, you're seeing some pretty big down days, and then you're seeing some little ticks up and then down again, right? It's almost like confidence to bring money back in, buyers, and then boom, you know, and that's what I expect, you know, 22 years ago. Now we're seeing it. So I think this is, from my own and my wife's benefit, this is a very smart way of putting money to work, because the banks don't give us any money, and certainly with inflation, we lose money if we put it in the banks. But whether inflation is 4% or 5% or 3%, the true inflation, when you add energy into the mix and food and some of the other things that they play games with, at the end of the day, I feel that real estate is very expensive. I feel the market is way overbought, and I feel that if you want to sleep at night, if you have very, very good fundamentals for underwriting, and you're taking on very good sponsors who are borrowing, I think this is a really good way of putting money to work with a very nice rate of return, with comfort and safety. So that's why we did it, and we're firm believers.
And I was in the same boat. I thought, like I kept saying, I was buying those 10, 12 cap rates, apartment buildings in the deep south for many years after 08. And when those were 3 and 4, I thought we were due for a crash too. I think the cheap money and some things have kept real estate going. But I said, I need to start a fund that's a lot safer for investors, where they're not all junior to the bank loans, but they're the bank loans. And I was mentioning that to a banker friend of mine who knew Paul, and we got together because we were saying the same thing. Real estate and residential may still go up for a year or 2 or 3, but it is overpriced. The real estate for office and retail has already come down. I think it could go down more. It doesn't really matter if we're at 50, 60% LTVs, even 65% LTVs. It doesn't really matter for us. If it goes down 20%, we're fine, because this is a safety play. But yeah, it's really interesting. Paul was saying the same thing. I thought we were due for a correction 3 years ago too, which is why I wanted to start this debt fund. but residential's continued to march along. And I think it's just that demand and supply delta. That's really how all the economists explain that, and 0% interest rates.
Part of our diligence was our friend who runs the big debt fund. It's called Loan Oak, by the way, and they've been extremely supportive to us. His name is James Watson. So
And we go invest.
and we go invest with them. You know, part of the diligence was that James, he's been doing this for, I want to say 18 years. We were investors in the 90s. James and I were investors in a variety of things in the 90s with loans, early 90s, in fact, when markets were really tricky then. And I said, so James, when you really, you know, pivoted to doing the fund from that day forward, we'll call early 2000s to now, how many loans have you done? How much have you originated? And how many losses have you had? That's what I really want to see. So he actually gave me his entire portfolio, and we're really close friends. And went through it all. And he said, well, you know, of the thousands of loans, whatever the exact number was, we've had about 20 defaults. He says, but I never get the properties back. I want to get the properties back, but you know, we're always bought out and they pay our penalties, they pay our interest. And he says there was a couple of occasions where we were close to maybe getting the properties back, and some of our investors early on were a little bit like timid. And he said, look, me and my partner, Jerry Tucott, he said, we'll just buy all the investors out. Here, we'll give you your money, you got your interest, and we'll take the risk associated with whether or not we really get these properties back. And he says, in those two instances, they resold them, they did get them, resold them, and they made more money, you know, because they had such a big spread. So the way I view it, I think we're all on the same page. If we ever got a property back, we'd be pretty fortunate because we have a nice spread. And quite frankly, you know, I don't know how this market ends. I don't know how I don't know what the next 5 years looks like, but it's pretty uncharted territory. And I much prefer to do something safe with loan to values that are conservative, with good sponsors. And if it's a worst case scenario, if we hit a recession or just something out of the blue happens, COVID related or unrelated or something new that we've never heard of, at least I'll know that we're sleeping good at night because properties have value. And certainly where we're lending, we're not lending in Palmdale or Lancaster and some of the tertiary markets. You know, in my career, I told you I was 61, and the cycles that I've seen in real estate is if you're lending to good areas, when there's a recession, the outlying areas get pneumonia. The good areas, they catch a cold. And I'd rather be catching a cold with loan to values that are very conservative than being kind of stretching it out to outer areas where, yeah, when there's a bad market, they can actually go down 25%. Good markets, maybe they go down, or more maybe, but good markets, maybe there's, you know, a spread, but it's pretty tight.
Actually, if I may, just interesting point, I do have couples in properties, one in Palmdale, one in Lancaster. Percentage wise, it went up more than properties taken away.
Oh,
So while the good times, as you said, that market is actually growing like crazy now,
right. Well, I guess
specifically Palmdale and Lancaster.
Well, that's what they say. The tertiary markets can go up more, but to Paul's point, they can also fall quicker. Think of it as a higher beta.
well, I saw also we're seeing a migration too. So we're seeing migrations out of high tax states into area, and because of employment with COVID, we're seeing places, low tax states or no tax states like Nevada, Tennessee, you know, all these other states where people necessarily weren't moving to, maybe moving out of, or that were very stagnant. Now they're having huge influx, you know, Florida, Texas, Tennessee, Nevada, where communities that were probably smaller markets are becoming much bigger and more in demand. So there's something to be said about that too. I mean, how that paradigm changes, I'm not sure. Obviously, less regulation, less taxes brings people back for sure. It makes things healthier. But in the meantime, I still feel California's a strong market. Very strong.
And my mother passed away a couple of months ago. She was elderly, it was okay. But I'm working with her house and the sale of her house, and I was surprised that the smaller markets out there, houses that are $500,000 2 years ago are now $700,000 to $850,000.
It's a percentage
All
wise,
within 2 years,
it's
yeah.
crazy over there. And actually
Yeah.
population wise, if you look at Palmdale, cityhall.com website, I mean, that city is growing like crazy, again, percentage wise. So
So you're opening your
As a
eyes to maybe a
short-term-
new market.
as a short-term investment, I mean,
Yeah.
it's really worked out.
Well, here's what I always say. Like, even though we did this in Wall Street all the time. someone would say, well, this is a really good deal. I said, well, I'm really not so familiar with that. We're the lead investor. Then I go, oh, well, if they're gonna actually put their money in this, what they say is a really good deal, that at least turns the light on for me where I have more confidence. So you're our expert now for Lancaster. Whether you're an investor or not.
You just got us some money.
You know,
What you have out there.
very much.
Replicate it. The desert's never gonna end. So you don't have security
That's right.
or the individuality of a well-located property
Agreed.
that you can't.
Also water rights. I know a developer who bought a very large parcel outside of Las Vegas. And then he was told that he couldn't have water. And that's a problem because people like to have water.
Agreed.
But I would keep it a short term, not long.
Well, let's put it this way. I own those two properties for 5 years now. They're 300% increase. 300.
No, and you've done very well. But don't talk to me in 5 years when they've gone down 350%. When the market goes out there.
He will sell the property.
He's lowering his broken down.
Right.
And at the same time, I can say, they're two small homes. I'm not- nothing
They're not
fancy.
gonna get hurt.
But there wasn't a month where they stayed empty.
Yeah.
I mean, the demand
The
is
demand
great.
is there.
I think because many people can't afford the POA.
Yep.
And with little cities around it, I
Well, no,
mean,
it's
people
grown,
nuts.
especially since COVID, because a lot of people now don't have to be in the big city because they don't have to go to the office.
I think that's really helping the
Yeah.
suburbs.
Right, but you were really smart when you bought, you didn't know COVID was coming.
Of
But
course.
It really helped, because now a lot of people can go out there, they can afford to go out there, and they don't have to commute to work.
Yeah.
And that's what's happening with office too, is that
Homes of 5, 6, 7.
Yeah.
Office-
But that's because people no longer have to come into an office. They can
Yeah.
actually live
That
there
too.
and they
That's-
can, they don't have to commute. But the other thing that's important is we're short-term money. So what Barry, Diane and I always talked about was what happens if market cycles shift? And we go back to 1979, which I remember, although I was young, in 80, where, rates went, skyrocketed 21%. I don't think we're gonna see that, but the point is, if rates start escalating, then with short-term money, and payoffs within a year, it's great. We just recycle the money and we get more money thereafter, 13 months going forward. So I think it's a defensible strategy. I mean, you were very wise when you bought in Palmdale and Lancaster. It's worked out incredibly well. And it probably will continue based on what COVID has done to commuting and why people now are living in those markets and the demand is so great. Our son-in-law and daughter owned a home in Westlake and they bought it, I want to say 2 years ago. They sold it like 9 months ago and they made money. I mean, they paid a lot of money for this house and it went up in value in a very short period of time. But then they relocated to Tennessee. They moved to Nashville because the pricing power was so great what they could buy there. And that's one of the #1 destinations because no taxes. It's a very youthful population. And the neighborhoods there are just, it's a whole different vibe, right? So who knows what's going to happen tomorrow, but at least, I think we all agree that real estate is a really good investment. And especially if you're in the right cycle as we'll call it equity owner, but being debt lenders, we just want to mitigate risk. We're looking to put cash, the banks will not give us literally any interest on, literally what, 0.25% to work in a very safe manner where the underwriting is very solid. And if the worst case scenario does happen, which we maybe will never see, at least we have that buffer where we can withstand whatever hits us and say, okay, worst case here, we end up with a property, and that's probably a good thing.
And that's where debt funds are different than acquisition funds. We're in it for 60% of the value. Acquisition fund is in it for 100% of the value. So in an acquisition fund, if you're in it for 100%, it goes down. Thank you. If you have questions,
so
just give me a buzz.
Yeah, I'll follow up.
And yeah,
Easier to
What's
walk
the
out.
saying in the deck? What's the team?
German soccer community.
yeah. So if you're in an acquisition fund and prices go down 5 or 10%, it hurts. If you're in a debt fund and they go down 5 or 10 or 15 or 20%, you don't really care. And that was the whole purpose of this. If there's a huge crash, I'll probably be looking to do some acquisitions again. I think you guys probably will too. But we're so high And it's weird, like I said, 3 years ago, I was expecting residential to crash, but the 0% interest rates and the supply and demand imbalance have kept it going. But at some point, it's got to catch up. I mean, retail and office have already been hit, but residential has just been a juggernaut.
So if you take a property back, does the profit or the loss, that goes into the fund?
So what happens is, on our loans, this is a great question. And the question, if you all didn't hear, is if we take a property back. So our interest rate jumps up all the way to 18%. What we get in court is all of our accrued interest, all of our accrued principal, plus that jumped up interest rate, which would actually help investors. They'll
From the
actually
date
do,
of default, right, yeah.
yeah, they'll actually do better. But to the question you're asking, no. What happens is, say for instance, we loan 5 million, and with our deferred interest and delinquent interest and principal and all that, we get back legal fees, we get back and all that, we get back 6 million, but it gets sold for 10 million. After we get that 6 million, including that 8% interest and all our legal fees, that extra 4 million, that goes to the trustee, which eventually goes back to the original owner's family or trust.
Okay.
So as a lender, we don't get all of that appreciation. But what is really nice is, and I don't know if you guys all know this, is bankruptcy. Chapter 7, Chapter 11 does not stop foreclosures. So if the borrower
Why
thinks
doesn't it stop foreclosure?
it is outside the bankruptcy court, if we have a lien on a commercial property to you and you declare bankruptcy, our foreclosure is in no way hindered. Outside the bankruptcy court. So if you borrow from us and you think BK is going to protect you, it's not. And that's really important because
Why are you protected when the only other thing I ever thought was protected was student loans?
so we're a secured lien, and actually even unsecured liens to a certain degree on commercial properties are outside the bankruptcy court.
Okay, so, but if you're like first, okay, but a first trust deed is also protected. If you're a normal lender and you have a first trust deed, the guy can go file bankruptcy. You don't get paid until the property's sold,
Correct.
and then you are paid first.
And that could be the same for us. The property may end up
I understand.
having to get.
Yeah, the lender laws in this country are very favorable, and jurisdictional in California is very favorable because it's a very smooth process. It's, it's refined. There's a lot of case law behind it. So in a foreclosure, it's an accelerated way of selling the property.
But selling a property is the best way. When I was at PennyMac, I took our foreclosures, and this is kind of after the crash, so we had money. And half of them, I sold the notes at a discount, the notes, the mortgage notes. And the other half, I gave to a realtor with a couple of $1,000 up to $5,000 for paint and carpet, and said, go sell them on the market. And I did this A/B test. Are we better off selling the notes at 95%? Or are we better off marketing it and selling it? And we did much better. It took longer. It took on average 3 to 4 months longer. But we did much better giving it to a realtor and selling it in the market and selling the notes on those note discount sites for less.
Okay, so are all of your loans first trust deeds?
No, we care about is the equity in the property. So Paul mentioned earlier that he's close with Lone Oak. Lone Oak is an interesting phenomenon. Their rates are less than anyone else. They're charging 5.95 if it's under 10 million, 4.95 over 10 million. But they do an internal appraisal that's really, really conservative, and then they take it down 20%. So if they're doing, and then they will go above 50%. So if they're going to go 50%, they're leaving a lot of meat on the bones. We will come in and sometimes do a second with them and take it all the way up to say 60, 65%. We're still at a great CLTV, combined loan to value, with a great partner. Our promissory note, well, our intercreditor agreement that we have with them says they don't even get any of their default interest, that higher interest or other things, until we're paid back our principal and our accrued interest in full. So we really like that that's pari passu. But we are not against that. I would rather be at a second with someone like a Lone Oak at a 65% CLTV, combined loan to value, than a first, like a lot of guys at a 75 or 80 LTV, Because what we really care about is how much borrower money is junior or subordinate to us. So we'll do both.
And
Okay,
also,
but if you're in a second position
Yes,
and you've got an agreement with the person in the first,
yes.
if they default, they're gonna probably default in the second before they're gonna default on the first.
We'll buy the first.
Okay. And do you have an agreement with the person with the first that if they default on the first, you can foreclose and then make the payments on the first?
That's in our intercredit.
that would be deemed an event of default for us as well.
And that's in our intercredit agreement.
Okay, but then you can still carry the default with first, and then you can go ahead and sell the products.
Right.
Yeah.
The other thing we do, by the way, I'll just add really quick, Barry, many times we take personal guarantees, and in some instances, we take cross collateralization on other properties in a sponsor's portfolio.
And I'm sorry, when you were asking about the, I lost my apologies.
How long has this fund been going?
It's pretty new. We only started it in 2019. And like I said, it was a reaction to, well, for me, being in an acquisition fund and seeing cap rates going absolutely crazy and saying, I don't want to put investors junior to bank loans anymore. I want to stay for fun. The fact that we were able to pay a great rate is because we can mix some conservative first and seconds in there and not put leverage. The other option is, institutional funding, they'll just make a blanket statement and say, we'll only do first. So the guy might have a first at 90%, and some of our competitors do, when we might say have a second at a 65% with loan. I would much rather be there. There's not a lot of people doing seconds.
We've also been offered by many leading financial institutions, big ones, who said, well, look, we'll lend on your portfolio so you can then do more lending. No, we're not interested in that, because that way would put them in a control position where we prefer to be in control A and be conservative B. We're not looking to lever. The whole idea, the way I look at, the next 20 years is not to be in a situation where it's problematic.
Well, even worse.
How much money
let's
is
just-
this fund now?
Right.
Just,
No leverage, you just.
No leverage, no one else to call the shots. We call the shots.
and just to finish Paul's point,
Yes.
even worse than the control issue that Paul was saying is those guys want to be ahead of the rest of our investors. They literally say, we'll give you a advance rate of 65%, but we're going to be ahead. We want all of our money back before the investors get a penny. So Paul mentioned control. I'll mention that they're trying to shove themselves ahead of you.
So how much money is in the fund now?
The loans are always turning. There's usually around 20 million, sometimes more, sometimes less.
And you have money in the fund, and he has money.
We both have substantial money in the fund.
So approximately what percent?
Probably around,
I think that's what we do.
probably around 22%.
So you do from that.
So the size of the fund is 20 million.
Yeah, it's not huge, but we always have loans turning and we're trying to grow it and we're very selective. But that 3 million average loan, that does about 17, 16 loans. They're always turning.
What percentage?
We're able to cherry pick though, which is nice. If we have more funding, we'll still cherry pick, but we have more loans right now than we have funding.
So I was curious when I read this thing, if you're really mainly first trustee, how do you get such a high percentage rate on a first trustee? At 60 to 65%?
Like I said, we do both, but the thing about it is for short term, we can do higher rates. The people don't really care if their goal is to refi out of us in 6 months.
And they can go to you and get a loan where they can't go to traditional lending.
And we can
They don't
close
wanna
in,
take the risk.
close in 5 days. We'll get a quick appraisal. We'll close in 5 days. Some of them panic. Some of them are like, I got a great bank loan, but they can't close in time. And if I don't close this by a week from Friday, I'm losing the property.
Right, they're gonna pay you a higher rate.
They'll pay us a higher rate. And then guess what? The very next day, they're working on their refi to get out of our loan.
It doesn't matter.
Doesn't matter.
And you guys get your fee mainly from charging points up front.
Management.
It's actually preferable, if you originate at 2%,
$10 million loan, a couple $100,000, and three weeks later it's paid down, great return.
Yeah,
Right, you get.
let's
you
get more of those.
Because it's a little bit different animal because it's a short-term loans. It's not like
Right.
Bank of America or like 20-year loans. It's a little bit different.
And that's why you can see the management needs to grow, because if we're paying out all the interest and we're only doing a loan here or there, we're not making much more than rent for a little overhead, but as we grow, we'll actually make some real money. So we need to continue to grow because we're giving all the interest to the investor. It's less than little AUM fee.
You get your fees up front.
Correct.
Okay. The points, and then you take what, 1% for management?
1% of the money in the fund.
Okay. So whatever the fund, 20 million, 30 million.
So if our average note is 10.5, then we'll pay out 9.5.
What percentage of your loans are you investing with loan up? Like,
What percentage of our loans? are-
yeah, I mean, I saw
I
the
would say-
sources there on there, instead of broker referral and things
Right,
like
I
that.
think it's probably about 25%.
Because that's the concern, like, where can you keep getting these deals that generate 10, 12%? Interest, like he's mentioning, it's high, but it's sounding like your loans are often kind of like mezzanine loans,
The reason I like,
second.
and the
second
reason I
loans, right?
mentioned Lono, and Paul mentioned it, is because they're so conservative with their
Right.
low appraisal. If somebody else comes to us, which they do, and they're like, Barry, I'm doing a first at 70%. Do you want a second to take it to 80?
No.
No,
Do you have a limit within the fund saying, or we're only gonna go to 65, or is there LTV constraint?
yeah, we've never gone above, well, the PPM, I think, says 70, but
Right.
I don't think we've ever gone above 65. If it's raw land, we won't go above 50. If it's a hotel, we won't go above 50, probably even less.
Right.
If it's a great property with a great borrower and a great personal financial statement, we'll probably go up to 65.
Are your guarantees, are they 100% recourse or 25, or what do you
The
get?
personal guarantees are 100% recourse. I'd say we have about 75% of them. To Paul's point, if they don't do a PG, then sometimes they'll cross.
Mhm.
But you're right, they are a little bit like mezz.
Right.
Mezz can get messy though.
What can get messy?
Mezzanine loans, because then you're
What's a mezzanine?
so a PG means if you don't pay me on this property, I can come after your personal assets. Mezz means I'm kind of loaning to your company. So that means if you don't pay on this property, I can kind of go after your company. And mezzanine loans can get a little sticky. I would much prefer a second in that case that's got a second or third or fourth cross collateralized property or a PG. I've seen mezz loans get very, very sticky. Some people kind of drool at them, lenders, because they think, oh, if I pay this right, I'm going to end up owning the company. Other questions? Thoughts? No, well, we're around. Thank you guys and appreciate you coming out on a Saturday morning, and
Finding
hopefully,
a place.
hopefully it was a mix of educational and a little bit of background on us.
Thank you, it was a good presentation.
Thank you.
Do you have a minimum?
For the Reg D, it's 25.
What Reg D?
That's accredited.